Okay, so I'm sharing the link to this video with you because we had a conversation about the content that I'm going to share with you. So this is about the correlation or the fact that housing real estate is not correlated with the stock market. And this was in a presentation, a webinar that I did about alternative investments and using a self-directed IRA to invest in real estate. But I'm going to start with the question, why is real estate the number one alternative? And it gets into the very reason for this particular video. So real estate creates wealth. It offers high yield returns. It produces cash flow. It protects capital. It's a hedge against inflation, and it is not correlated with the stock market. So this non-correlation is important, and that's what I want to spend this video demonstrating. So I have two charts here. The one on the top is the real estate market, and this comes from the Federal Reserve. The Fed in St. Louis has a great website with lots of data, and you can download this chart. And this is a 60-year chart from 1963 to today, and I'm recording this in 2023. So this is a 60-year chart of housing prices in the United States. And comparing that to the chart on the bottom, which is the Dow Jones Industrial Average over the last 60 years. And this was taken from a 100-year chart. This is available pretty easily online. If you just search for the Dow Jones 100-year chart, you'll see it. There's a lot of websites that show this chart. And as we take a deep dive into these two charts and compare and contrast them, I just want to point out that the gray vertical bars, or the gray shading, these bars where my cursor is going up and down right now, they are recessions in the United States, economic recessions. And this is what I'm going to focus on, and how the stock market and the housing market are impacted by recessions. So we're going to go over each of these sequentially. So in 1970 is the first one, the first recession we're going to look at. And you can see, I just put a circle there, and I'm going to be doing this so you can follow along with me. So you can see in 1970, when that recession hit, or just prior to that recession hitting, housing prices started going down and then bottomed out during the recession, and then came back up after the recession. But look what happened to the stock market during that recession. It really spiked down pretty significantly. And then looking at 1973 and 1974, look what happened with house prices during that recession. House prices acted as if there was no recession at all. They just kept going up and up throughout that recession, both before and after the recession. And then when we look at the stock market, we can see a big difference there. So house prices took stock prices took a big hit during that recession. You could see that spike down. And then in 1980, 81, 82, 83, there were back-to-back recessions. And you can see the housing market in 1980 kind of went down just a bit, leveled out, and then just continued to go up, as if the recession was a little bit more volatile. House prices were a little bit more volatile than normal, but in the big picture, house prices went up during those recessions. Compare that to what happened to stocks during those recessions. In 1980, there's a spike down, and then again in the 81 to 83, a pretty significant spike down in stock prices. Now, the arrow that I just put on the stock chart is the crash of 1987, which took place, which did not take place during a recession. And I remember that event. It was pretty significant, and it was a major economic news event. But at that same time, if you look at the house chart. I don't even have a circle around it. Maybe I should have put it, but it just the housing market did not get impacted by that crash in the stock market, at least house prices. And then in 1990, the recession, the housing market went down a bit, mostly stayed level, but it did go down a bit. And then stocks, you could see that spike down during the recession, very much more significant than the house prices. In 2021, very similar to previous recessions, housing prices were a little bit more volatile, but the general trend was that house prices kept rising throughout that recession, and both came out higher than before the recession. But compare that to what happened in the stock market. So stocks had been going down, that recession hit, stock prices continued to go down. And then after that recession ended, stock prices plummeted, and the housing market did not experience that. It was no similarity with the house price market. Then in 2008, 2009, this is the housing crash, the Great Recession, which was the housing recession. And you could see that housing home prices went down, and during that recession, there was a little spike down, but there was definitely a general downward trend. And even after the recession, it continued to go downward for several years. But compare that to the stock market, which the bottom just basically fell out of the stock market prices. Now, going back to the house price chart on the top, you can see that house prices started to go down before the recession actually hit. And this was a failure. The housing market crash was not a problem with houses as an asset class, but it really was a mortgage industry crash. And the U.S. had policies that I think set this up for many, many people to fail in being unable to pay their mortgage. And so it was a mortgage failure. It was an economic failure of policy. And so when house prices started going down and banks started going bankrupt and there were a lot of foreclosures, just the whole system just kind of snowballed, and house prices went down pretty significantly. And meanwhile, prior to that recession, stocks were going up. And then once that recession hit, they plummeted, and they fell at a greater rate than house prices, even though this was a housing recession. And so the stock market just got impacted big time, very volatile. And then in 2020, this is the coronavirus recession. Home prices prior to coronavirus were kind of flat. And then when coronavirus hit, they went down a bit. And then buyers started coming out, and there was a lot of inventory on the market, and a lot of home sales. And interest rates were very low, and we had tremendous volume of home sales, and the prices of real estate went up. House prices skyrocketed during this time. And then the mortgage interest rates have gone up, and we can see in 2022 and 2023, there's a slight downturn, but it's mostly continues to be in the high price range for housing. And comparing coronavirus recession to the stock market, you could see stock market prices dipped, were way more volatile and shot down to a greater degree than home prices did during that recession. So that's what I wanted to bring to you, is the big takeaway is the non-correlation, that real estate is not correlated with the stock market, and is a great way to diversify your investment portfolio. And before I go, there's like a bonus material here that I want to show you. So if you're into technical analysis of stocks, you might appreciate a little bit of what I'm trying to do here with this housing market. So I drew a red line from 1963 at the bottom left of the housing chart all the way to the bottom of the coronavirus recession price point. And you can see that straight line. And that would represent the floor of house prices if we kind of got back to the normal rate of the growth of home prices. But I looked at it in a couple of other ways too. I also went back to the low point between the prior to the 2020 recession, but after the 2008, 2009 housing crash. So that was probably about 2012 that bottom, and drew the line to the bottom of the coronavirus recession. And you can see that green line. And then I drew in the black line a low point prior to the coronavirus recession, but after the previous one. And you can see that black line. And in my way of thinking, the black line would represent maybe the ultimate floor of house prices if there were to be a housing crash, price crash. But this is just speculation on my part, but it is data to analyze and data to look at. And if home prices were to crash either to the red line or the green line or the black line, house prices will be higher than they were during the coronavirus recession. So anyway, just kind of interesting to speculate about that. I don't think that's going to happen. I think because of inflation, low inventory, and then when the mortgage rates go down, they're coming down a little bit at late 2023 right now. I think that's going to impact sales next year. There'll be a greater volume of buyers that will be out there, and a lot of demand for a lot of pent up demand for houses. And I don't think the prices are really going to dip very low. But if something were to happen, I think the red, green, or black line would be the bottom of a housing crash. That would be somewhat catastrophic, but that would be, I think, the bottom. So anyway, that's all for now. If you have any questions about this, just contact me, and I'd love to talk to you more about this. Thanks.